Good afternoon, everyone, and welcome to today's webinar on the tax provisions of the CARES Act. My name is Joe Bublé. I'm a tax partner in the New York City office, and I'm also the firm's tax practice leader. Let's get started, and to do that, I'd like to turn it over to Paul Daly, who is a tax partner in the New York City office. Paul, welcome.
Thank you, Joe. Appreciate it. I'm going to be talking about the bonus depreciation for qualified improvement property. Please move the slide. Thank you. This is kind of like an easy fix. It was supposed to be in technical corrections, and unfortunately a disaster had to make it happen, but this is what's happening in terms of technical corrections. It's supposed to increase liquidity, meaning to get cash, well-needed cash, into taxpayers' hands. And even though the times are trying to hopefully incentivize people going forward to now have this bonus depreciation for qualified improvement property, or known as QIP. The industries that are really affected are the hospitality industries, more so restaurants, and also real estate. It is effective for property placed in service after December 31st. 2017. The 2017 TCJA allowed for 100% of bonus depreciation. It was supposed to apply to qualified improvement property, such as qualified leasehold, retail, and restaurant improvements. But what was known as a retail glitch precluded taxpayers from taking advantage of the tax break. It was purely a drafting error, unintentional. CARES Act, however, provides a fix. What is qualified improvement property? It's any interior improvement to non-residential real property. That's key. Non-residential real property, first placed in service. Must be an improvement to an existing building, first placed in service. Includes lighting, exit signs. Does not include enlargement of a building, elevator or escalator, or the interior structural framework of a building. It can, however, include non-structural improvements to common areas of a building. By making qualified improvement property now 15-year recovery property as compared to 39, this was the glitch, meaning that, again, it was unintentional, but it was for bonus, it's only for property with a recovery of 20 years, recovery period of 20 years or less. For whatever reason, again, a drafting error, qualified improvement property under the old law had a 39-year life and therefore was not eligible for bonus. Qualified improvement property also was assigned a 20-year class life for ADS, alternative depreciation system, and also, which will be discussed later by Michael, in terms of 163J, when a real property election is made, it's 20-year and no bonus. One thing that was noted under the new law, which was interesting, is that the new law specifically clarifies that QIP only includes improvements made by the taxpayer. So there's a lot of question as to what that means, meaning that most of the time you would only be able to depreciate improvements that you place in service. But there's a lot of issues on that, and I think that we certainly need further clarification. Will the UNICAP rules, which include property, which defines property produced by or for a taxpayer, will they apply to determine if QIP is made by the taxpayer? The inclusion of this language also may mean that partnership basis adjustments arising when a partner sells their interest may not qualify for bonus depreciation for the portion of the purchase price allocable to QIP. Clarification is needed. And also the phrase likely rules out bonus depreciation used bonus depreciation on used QIP, meaning that the inference clearly seems to mean that improvements to a non-residential building acquired by a taxpayer after having been previously placed in service by another taxpayer, more likely than not will not meet the modifications modified definition of qualified of QIP, even if otherwise all the criteria are met. To sum it up, what this now provides us with is refund potential, which is obviously key. And I'm going to turn it over to others who will be talking about how to do this in terms of claiming refunds or amending returns. And also, my partner Eugene will be talking about the state ramifications, because we're only talking about federal, and there might be ramifications in terms of now electing this bonus on the state consequences.
Good afternoon, everyone. So as we've heard from Paul, there is some retroactive tax relief available, and we'll hear from others throughout the afternoon about the same. And as we think about this, the idea of amending a return first comes to mind. Andy will talk later about other options. But one of the first items we have to address is specific with partnerships and whether we are actually able to amend. With the Bipartisan Budget Act of 2015 introduced a new centralized audit regime for partnerships that, for the most part, unless you opt out, do not allow for an amendment. There's other procedures you must go through. So this new regime applies to all partnerships with taxable years that start after December 31st of 2017. And the ability to opt out there at the bottom of the slide, you can opt out if you have 100 or fewer partners looking through to your S Corp shareholders. And then you have to be a C Corp, S Corp. Your partners have to be a C Corp, S Corp, a state of a deceased, or a foreign entity that would be treated as a C Corp. And this election out has to be made on the return. To the extent that you are not able to elect or opt out, in order to make an adjustment to a previously filed return, the partnership has to file for an administrative adjustment request. And this is an adjustment filed with the IRS and provides numerous different forms, one of which is provided to your partners showing the adjustment that is being made. The issue that comes into play is that form that you provide to your partner, so in the case of a change in your prior depreciation, would be a benefit to your partners. They would receive that form in 2020, and that would be considered a 2020 tax document. The IRS recognized that that is not beneficial in order to get money back in taxpayers' pockets. If that is a 2020 tax document, presumably that you would not see a benefit until 2021 when you file the return. And so they came out with relief last week. And if we go to the next slide, please. They introduced Revenue Procedure 2020-23, recognizing that they did want to provide for amended procedures and provide temporary relief for that for BBA partnerships. So now we have the ability for partnerships that have tax years beginning in 2018 or 2019 that have already filed their 1065s and provided the K-1s prior to April 8th of 2020. Those partnerships are now permitted to amend those tax returns where we were not able to before. So that is a huge benefit that was certainly welcome, and we were glad to see. Those amendments need to be made, though, prior to September 30th of this year. It's important to note that this is only temporary, and it's important to note that date as well. So if there's any partnerships that have not been filed, they need to be considered before they are filed. In addition, there are a few procedures that we need to be aware of. If there was any guilty that were on the returns, there's special coordination provisions with regulations that the IRS issued. In addition, if there are any partnerships that are currently under examination, you need to be working with your revenue agent that is providing the examination and work through them in order to file that amended return. And it's important to note that this does not prevent a taxpayer from actually going through the AAR procedures, or the Administrative Adjustment Request procedures, that was otherwise allowed under the BBA. And Andy will talk in a minute on why it may not be beneficial to amend. There may be other options. You know, some of those you need to look at your partners in each year, what the benefit is, and what frankly, the pain would be to amend and have all your partners amend. So with that, I'll pass it over to Andy, and he can talk about some of the other options.
Thanks, Sean. Good afternoon, everyone. As previously mentioned, the CARES Act contains a much-needed technical correction that changed the classification of qualified improvement property effective January 1, 2018. This correction treats qualified improvement property as 15-year property and thus allows taxpayers to apply 100% bonus depreciation, and also changes the alternative depreciation system, or ADS, recovery period from 40 years to 20 years. In this segment, we're going to discuss how to take advantage of this new law change using accounting method changes. This retroactive change to the classification of qualified improvement property is summarized as follows. The regular recovery period under the Tax Cuts and Jobs Act was 39 years. Now, under the CARES Act, it's 1 year. Electing out of the regular recovery period, we expect the IRS will allow an election to use 15-year depreciation in lieu of bonus. And for electing real property trades or businesses, which are those businesses that chose not to have the new business interest expense limitations apply, ADS depreciation will be changed from 40 years to 20 years. So following the CARES Act being signed into law, the depreciation method used to depreciate qualified improvement property on 2018 tax returns is now an impermissible or incorrect method of accounting. In order to obtain the tax savings associated with this law change, we need to change from an impermissible or incorrect method of accounting for depreciation for 2018 qualified improvements to a permissible or correct method of depreciating qualified improvements. There are two ways to accomplish this. We can amend the 2018 tax return, as Sean was talking about before, or apply for an accounting method change in 2019. Let's see what these two alternatives look like. By amending the 2018 tax return, you would either change depreciation from 39 years to 1 year. You could elect out of bonus depreciation and change to 15 years. Or you could change your alternative depreciation system, from 40 years to 20 years for electing real property trades or businesses. As an alternative, by changing our method of accounting, we would accelerate the remaining 38 years of depreciation not taken in 2018 on the 2019 tax return, thereby claiming the missed depreciation as a favorable adjustment. Or you could deduct the 2018 difference between 39 years and 15-year depreciation on the 2019 tax return and depreciate the remaining cost basis over the next 14 years. Or you can deduct the 2018 difference between 40 and 20 years on the 2019 tax return and depreciate the remaining cost basis over 20 years beginning in the 2019 tax year. So how do we determine the best year, the best method for taking this additional depreciation? Should we amend our 2018 tax return, change our method of accounting in 19, or perhaps continue to use an incorrect method of accounting and change to a correct method in 2020 or some future year? This decision can depend on a number of different factors, including your immediate cash needs. As Sean mentioned before, you might have different partners in 2018 than you would have in a future year. Prior, current, and future years' taxable income, impact on your net operating losses, the business interest expense limitation. There are a whole host of various international provisions that we're not going to cover today. Or it can just be a matter of not wanting to amend your prior year returns simply because there are multiple levels of partnership tax returns affected by this change, with a significant number of individuals that file in multiple states, and amending tax returns would be overly burdensome or too costly. Similar to what we experienced with recent tax reform, modeling of all of these and other CARE Act changes will be critical. So let's talk about some basic concepts in accounting method changes. What is an accounting method? Well, accounting method is a set of rules that determines the time, meaning tax periods, for reporting income and expenses. When you think of accounting methods, I think of cash versus accrual, the method of depreciation, and so on. Classifying the treatment of an item as an accounting method means that if a mistake was made in a prior year barred by the 3-year statute of limitations, let's say no depreciation was taken on an asset for the last 5 years, I can likely correct that mistake in the current year by changing my method of accounting. What are changes in accounting method and why are they so important? Well, changes in accounting methods usually involve changing from an incorrect method to a correct method, or from one correct method to another correct method. Changes in accounting methods are important for a variety of reasons, including they can allow us to take deductions in the current year that were missed in prior years closed by the statute of limitations and can provide audit protection. Why does the IRS allow changes in accounting methods? Well, basically, it's really just to encourage compliance. Once a taxpayer adopts a method of accounting for an item, the taxpayer must obtain the consent of the IRS to change its method of accounting. There are 2 ways to accomplish this. First, by filing Form 3115 under the automatic change procedures, or by obtaining the advanced consent of the IRS. The instructions to Form 3115 currently show 239 automatic changes in accounting. So how do we make our change in accounting? Well, first and foremost, it's important to note that changing from an impermissible or incorrect method of tax depreciation to a permissible or correct method of tax depreciation is an automatic change in accounting. It happens to be designated change number 7. This change is made by preparing Form 3115 and attaching it to the filer's timely file tax return, including extensions. And you also need to file a duplicate copy with the service as provided for in the instructions. Although authority exists for making this change in accounting, we spoke to the IRS National Office about making this change, and on an informal basis, they had the following to say. The IRS confirmed for us that designated change number 7 provides the way forward for making this automatic accounting method change. The service is considering all options that would serve to simplify this process. For example, having taxpayers take this deduction without having to file Form 3115, and perhaps eliminating some of the barriers for making this change contained in the revenue procedure. In prior years, when Congress had retroactively extended bonus depreciation, the IRS issued guidance that allowed taxpayers to do either or, pretty much the same what we're talking about today. The service plans on issuing procedural guidance this time around as well. So based on this history, it might be prudent to wait for procedural guidance before filing your change in accounting method. Next slide. The change in accounting for depreciation is just one of the many ways to accelerate deductions to produce tax savings. As you proceed with the preparation of your 2019 tax returns, I would encourage you to explore additional opportunities to make accounting method changes. The following is my top 10 list of accounting method changes that might help to maximize tax savings this year. And at this point, I'd like to turn the presentation over to my partner, David Seiden.
Thanks, Andy, and good afternoon, everyone. I'm David Seiden, partner in charge of Citron Cooperman's state and local tax practice, and I'm very happy to be speaking with you today. Given the amount of time I've been given and the amount of information I have to get through, I decided to forego my customary awesome opening joke in the interest of salt knowledge. I know I'm sorry, everybody looks forward to it, but it has to be this way. I do want to start by asking a question. What impact does the CARES Act have on state taxes? Now, I'm sure some of you are thinking, if you knew the answer to that, you wouldn't need to be listening to me at this point. All I can say is fair point. So the answer is what many attorneys say about most things. It depends. It especially depends when you're trying to answer a general question that involves 50 states that have 50 different taxing regimes. So while the typical answer to a general state question is it depends, the good news is virtually all states have or start with federal taxable income as their starting point in calculating state taxable income. Unfortunately, that's where the good news ends. After federal taxable income, most states fall into one of three categories. Category 1 being those states that by statute have adopted the most recent version of the Internal Revenue Code. This is referred to as rolling conformity, and there are about 23 states and DC that fall into this category. It's important to note that even if a state has rolling conformity, which means they follow today's code, it does not mean that they have not significantly changed or modified certain provisions within the most recent code or any act thereafter. Category 2 are those states that have adopted a specific version of the code or as of a specific date. For example, California statutes adopt the Internal Revenue Code that was in effect as of 1/1/2015, which means, again, they didn't adopt the TCJA, they don't adopt the CARES Act, so on and so forth. This is referred to as static conformity, and there's about 21 states that fall into this category. The last category is states that don't adopt the Internal Revenue Code at all by statute, but rather only enact specific sections of the code. This is referred to as selective conformity, and only about 3 states fall into this category. So the first step in determining how the CARES Act impacts a specific state is to determine whether such state uses rolling conformity, static conformity, or selective conformity. Now, in fact, in order to show how the CARES Act can affect a taxpayer depending on whether the state uses rolling conformity, static conformity, or selective conformity, I'm going to go through how this impacts 2 states, New York and California. Starting with New York, up until the CARES Act, New York was considered to have rolling conformity with certain modifications, which means, like I just said, they adopt the last version of the Internal Revenue Code, but they have specific exceptions within their own statutes. But of course, New York never makes things easy, so they decided to maintain rolling conformity with respect to the CARES Act for corporate taxpayers, but changed to static conformity for individual taxes. So that means that, yes, for corporate taxpayers, they enacted the CARES Act, but for individuals, they did not. Their statute says effective for the Internal Revenue Code as of some date in the beginning of March of this year, which precludes the CARES Act. So, for corporate taxes, let's take a look at the 3 main tax provisions of the CARES Act. The first being the Qualified Improvement Property, QIP, that Paul spoke about a little bit earlier. This one is a bit weird because while New York should follow the reclassification of QIP from 39.5 to 15 years, New York specifically prohibits the use of bonus depreciation under 168K and requires taxpayers to use the depreciation methods found in Internal Revenue Code 167. So for this purpose, it's straight line depreciation. So while the CARES Act created this great benefit for federal tax, moving property from 39.5 years to 15 years, and then letting you use bonus depreciation to expense it all in 1 year, it appears for New York purposes that you can get the reduction in the useful life from 39.5 to 15 years, but you can only use the straight line depreciation. Now, having said that, the shortening of the useful life should generate additional deductions and therefore potential refunds. So if you do have qualified improvement property, you can go back to 2018, change it to 39.5, from 39.5 to 15, and then depreciate it straight line over 15 years. The second major federal change related to the reduction in the interest expense limitation under 163J. What a shocker. That's sarcasm, by the way. New York has specifically excluded this provision for tax years 2019 and 2020. So no benefit for New York corporate taxpayers with respect to the benefit provided under the CARES Act was with 163J. The last major federal change was the ability for corporations to carry back NOLs. This benefit in the CARE Act has no effect in New York, given the state has its own set of NOL rules, separate and apart from the federal rules. So a quick recap for New York corporate taxpayers. New York does have rolling conformity with respect to corporations, but the only real effect caused by the CARES Act was the shortening of the useful life of qualified improvement property. A little different for individuals. New York, like I mentioned, decided that they didn't want the provisions of the CARES Act to have any effect in New York. So all I can say at this point is that if you're evaluating whether or not to do an NOL carryback, which is now allowed for federal purposes, be careful, because it may very well result in the inability to use such losses as a carry forward in New York. So if you carry back your NOL, there will be a cost because you're not going to get the benefit likely in New York State. California is not a rolling conformity. Like I mentioned earlier, it's static conformity, and it adopts the Internal Revenue Code in effect as 1/1/2015. The bottom line for California is the state did not adopt the changes made by the TCJA in 2017 and did not adopt any of the CARE Act provisions recently adopted. Having said that, there are still a few unanswered questions for California taxpayers, including whether the state will allow for the shorter life for the qualified improvement property, like I mentioned, for New York. And just knowing California tax the way I do, I can guarantee you there are going to be many issues that are going to arise as time goes on. 5 takeaways, nothing else from this section. Number 1, each state is different. You have to appreciate that the impact of the CARES Act has to be looked at on a state-by-state basis. Number 2, the answer, and even in a given state, on how it affects businesses and individuals can be different. Look at New York. Rolling doesn't mean full adoption. So that relates to the question that was asked earlier, where 50% said yes, 50% said no. Rolling means they adopt the code, but most always have provisions that either modify or get rid of certain provisions within the code. 4, states will make statutory modifications over the next 6 months. The one thing that is certain, that whatever you think the rules are today could very well change over the next 6 months. And then finally, number 5 is, please be careful when looking at some trade-offs when you have taking advantage of the federal NOL provisions and what the effect may be in any particular state that you're looking at. Finally, I just wanted to put this slide out there for everybody to get a sense as to, this is just one small piece of all the issues that are going on in state and local taxes right now that affect businesses. The COVID-19 disaster, tragedy, whatever you want to call it, has created havoc for so many states. Even the simple one as passing legislation to extend due dates. I want to thank our wonderful governor of New Jersey, who decided to give everybody at least 24 hours notice yesterday when he decided to extend the filing due dates. Yes, the day before they were due. And when you go down the list, all of these things are changing every single day. Every single day, states are changing due dates, extending due dates, letting businesses hold money, deciding whether or not, because people are working from home, it creates nexus for the company. There's a ton of issues that are going on. And we intend to do another webinar in the near future addressing all of these issues. With that, I'm going to pass this on to my distinguished colleague, Michael Klein.
Thanks, David. Hi, my name is Michael Klein. I am a tax partner from the Philadelphia office. Today, I want to talk to you about 163J. For those of you that aren't familiar with that code section, when the TCJA came out in 2017, Congress sought to limit the amount of interest expense that was able to be deducted by businesses. And the way the law, just as a summary, the way the law works is you measure a business's adjusted taxable income, and you were allowed to take a deduction of interest expense equal to 30% of that amount. Now, this law was intended to only affect large corporations. Those corporations were measured by gross revenue, and if your gross revenue over a 3-year average exceeded 25 million, then you would be subject to this limitation. By the way, the limitation has increased to 26 million last year. However, there were certain exceptions to the over $25 million rule, and one of them was if you were considered a tax shelter. And if you sift through the code, we discovered that a tax shelter is defined as any type of partnership or association in which losses are allocated to more than 35% of the limited partners. If your business was defined as a tax shelter, then you would also be subject to the interest limitation. Well, that definition pretty much brought in almost all real estate developers and real estate partnerships because of the way that real estate partnerships are set up. So the limitation had a much more wider effect on clients than we had thought. So that's just a small summary of what happened with the TCJA when this 163J limitation came out. So with the CARES Act, the Congress sought to try to soften some of that blow, and it increased the limitation from 30% to 50% limitation for the years 2019 and 20. So now businesses can take an interest deduction of up to 50% of their adjusted taxable income. And adjusted taxable income for most taxpayers will be taxable income with add backs of interest expense, and for the years up to 2021, you also get to add back depreciation and amortization. In addition to increasing the limitation from 30% to 50%, which will now allow these businesses to take more of an interest expense deduction, they also added a couple more provisions that were very advantageous to the taxpayers. First, the taxpayer can elect not to use the increased limitation. I'm not sure what the scenario would be where a taxpayer would elect not to use the increased limitation, but I am sure if we think about it long enough, we'll find one. The second one was that for 2020, taxpayers can use their 2019 adjusted taxable income for 2020. The reasoning behind that is that it's believed that in 2019, most businesses will have higher adjusted taxable income than they will in 2020 because of the COVID disaster. Because the 2019 adjusted taxable income is higher, that'll allow businesses to take a larger deduction in 2020 if they use the 19 adjusted taxable income instead of 20, which is anticipated to be lower. So that provision will come through for taxpayers as they file their 2020 return. They'll measure the 2019 ATI versus the 2020 ATI, whichever is greater, that's the one they should use. It's interesting that the increase in the ATI to 50% in 2019 only applies to corporations and S corporations, and it does not apply to partnerships. The partnerships will be allowed, however, to increase the limitation from 30 to 50% in years beginning in 2020. Partnerships will also they will also be able to elect in 2020 the ability to use the 2019 ATI, as I mentioned previously. However, the partnerships don't get totally minimized because of the 2019 because they are not allowed to use the 50% limitation in 2019. The legislature put in other provisions to give them some relief in 2000 while filing their 2019 return. So partners may elect to use 50% of any of the excess business interest expense allocated to them with their 2019 K-1s as paid or accrued by the partner in the partner's first year beginning in 2020, and it will not be subject to any limitations. So what that means is if a partner was limited or a partnership was limited in deducting their interest expense in 2019, the amount that was limited got passed through to the partners to be used in a future year when the partner has excess taxable income. However, because the IRS did put the provision in to allow them now to take 50% of that excess and take it as a deduction in 2020. So if I'm a partner in a partnership and my excess business interest expense allocated to me was $200 in 2019, I'll be able to take $100 of that and use it on my 2020 return as a deduction, and the remaining $100 will be carried forward, and the 163J limitations will be applied as usual. So partnerships will receive a break in 2020. As I stated that because much of the 163J applied to real property trades or business because of the tax shelter rule, along with the TCJA, they allowed partnerships they allowed electing real property trade or businesses to elect out of the 163J limitation. If you elected out of the limitation, you were able to deduct 100% of your interest expense. However, you gave up some ability on depreciation, which I'll discuss later. Under Section 4, the IRS issued Revenue Procedure 2020-22 last week, and under this provision, under Section 4, they're allowing real property trades or business to make a late election for years 2018, 19, or 20. So that really means is if a partnership forgot or neglected to make the election, or looking back should have made the election, they now have some relief to go back and make the election. This may allow them to deduct all of their interest expense from 18 or 19, and also 20 as well. To do this, they would need to file an amended return if they're an individual. If it's a partnership, they would need to file an amended 1065 or an AAR, as Sean talked about earlier. Under Revenue Procedure 2020-23, which Sean talked about, for filing the amended 1065, those provisions are in there. And if you are able to file an amended 1065, you must file it by October 15th, 2021. That amended return must have the late election attached to it, and the details of the election can be found in this Revenue Procedure 20-22 under Section 4.04. So the IRS is allowing you to make a late election. Because the rules changed under the CARES Act, they're also allowing you to withdraw the 163J election of electing out of it. They're allowing you to withdraw the election. So back again in 2000, when the TCJA Act came out, many real property trades or businesses made the election to not have the 163J limitation applied to them. Because of that, they were able to deduct, again, all of their interest expense. However, as I said, they did give up something. If you did elect out of 163J, you got to deduct all of your interest expense. However, you were forced to depreciate all property over a 10-year life under the ADS depreciation method. So if you were non-residential, if you had non-residential property, you would depreciate the property over 40 years as opposed to 39. And if you were residential, you were forced to depreciate over 40 years as opposed to 27 and a half if the property was placed in service before 2018. In addition, you were not allowed to take bonus depreciation on any property with a life of more than 10 years. Therefore, it didn't make much of a difference because the bonus depreciation was not allowable, as Paul Daly spoke about, until recently. So now, because of the increased limitation from 30 to 50%, and because bonus depreciation is now allowed to be taken on qualified improvement property, taxpayers may want to consider whether they want to keep this election. When the election was made, it was irrevocable, but because of this revenue procedure 20-22, it is now revocable for this year. In order to revoke the election, first of all, if you don't revoke the election, you still could get some relief because of the change in the qualified improvement property depreciation life going from 39 and a half to 15. Under the ADS life, which you're required to be on, you can depreciate this 39 and a half of your property that you were depreciating over 40 years, you can now move that to 20 years. So even if you don't withdraw the election, you still may be able to get a depreciation, an extra depreciation deduction in the current year. In order to make the election to withdraw, you must make a timely filed amended return, 1065 or AAR for the year the election was made, with the withdrawal election attached. You would see revenue in this revenue procedure 20-22. If you look at section 5.03 of the revenue procedure, it will describe the withdrawal election. So in conclusion, there's a lot to consider if 163J does apply to you, or if you elected out of 163J back in when you filed your 2018 return, because of the CARES Act, the situation has changed drastically, and there are people who may want to jump into 163J and use the limitation, but there may be a great amount of people who want to revoke what was thought to be an irrevocable election. With that, I'd like to pass the baton over to my favorite international travel partner, Allison Brack.
Thank you, Mike. You're my favorite international travel partner as well. In addition to the favorable changes made by the CARES Act to qualified improvement property, as Paul explained, and the business interest expense rules that Mike just talked about, another taxpayer favorable provision of the CARES Act is the change it made to the treatment of net operating losses. To just go backwards for a minute, the Tax Cuts and Jobs Act had changed the rules related to NOLs incurred after 2017 in two unfavorable ways. It prevented the carryback of an NOL that arose after 2017 so that they can only be carried forward. And it limited the amount of income that taxpayers could offset with an NOL incurred after 2017 to 80% of taxable income. The good news is the CARES Act alleviated these limitations for NOLs incurred in 2018, 19, and 20. For NOLs arising in these years, 100% of such losses can be used to offset taxable income. So the 80% limitation is gone. And these losses can now be carried back for up to a period of 5 years. These rules apply to individual taxpayers, trusts, estates, and corporations. The ability to carry these losses back is very beneficial for a couple of reasons. Not only does it enable taxpayers to receive refunds of taxes previously paid, rather than having to wait to reduce future taxes, but carrying these losses back is more valuable from a dollar's perspective because tax rates were higher in those years than they are now, which means that every dollar of deduction results in a larger benefit. It is clear that there will be many taxpayers with losses in 2020. However, these rules apply to losses incurred in 2018 and 19 also. For that reason, it is important to check two things. One, did you have a net operating loss in 2018 or 2019 that you thought you could not carry back? And two, are there provisions of the CARES Act that would enable you to amend your 2018 or 19 tax returns and create a net operating loss? For example, the technical correction to the qualified improvement property that Paul spoke about will cause assets that were placed in service in 2018 and 19 and previously depreciated over 39 years to be 100% currently deductible using bonus depreciation. And as Andy explained, taxpayers can either amend their 2018 tax returns to reflect this change, or they can take the benefit in 2019. They don't need to wait until 2020 if they don't want to. In addition, the limitation on excess business losses was removed for 2018, 19, and 20. So taxpayers that were subject to this limitation may end up with a net operating loss after the limitation is removed. I would highly suggest reviewing your 2018 and 2019 tax returns, if 19 is filed already, to determine if you can benefit from any of these and other changes. However, it's not an automatic decision to simply carry the loss back if you have one. There are some other factors to consider in determining whether it might be better to carry it forward. David Seiden spoke about one of them earlier, state tax considerations. Carrying the loss back for federal tax purposes may result in a loss of the benefit on the state side. Also, if a taxpayer was in a lower tax bracket in prior years, it might be better to carry the losses forward to a year when they'll be in a higher tax bracket. So how do you carry a loss back? Well, there's a specific order that you must follow. You can't just pick and choose which year you carry back to. You must go to the oldest year in the carryback period first, then the next oldest year, and so on. So for a 2018 loss, it must first be carried back to 2013. Then after you've offset all your 2013 income, it goes to 2014, then 15, and so on. 2019 losses must first go back to 2014. In terms of what forms to file, there are two choices. There's the quick refund option on Form 1045 for individuals, trusts, and estates, and Form 1139 for corporations. If you can't use these forms, then you would have to file an amended tax return for each year that you are carrying the loss back to. So the quick refund applications are a much better route for a couple of reasons. They allow taxpayers to get the refund quicker than if they filed an amended return. And it is a much more efficient way to carry back the loss, since you can offset income for 3 years on one form rather than having to amend 3 separate years worth of returns. However, there's a due date for the quick refund forms. They must be filed within 1 year after the last day of the year that the NOL arose. So for losses arising in calendar year 2018, taxpayers would not have been able to use these quick refund forms because they would have been due by December 31st, 2019. Thankfully, the IRS issued some guidance last week to address this and a few other issues that got created as a result of this new ability to carry losses back. So even though the CARES Act allows for 2018 NOLs to be carried back, the Act did not provide additional time to file the quick refund applications, even though the due date for the ability to do so had already passed. So the IRS issued Notice 2020-26, providing an additional 6 months to file the quick refund claims for NOLs arising in a tax year that begins during 2018 and that ends before June 30th, 2019. The IRS also announced just yesterday that these forms should be faxed to the IRS rather than mailed. They indicated that the IRS is currently receiving so much mail that the US Post Office can no longer hold it, and that the IRS is actually holding this mail in trailers until employees can get back to work. There will be specific fax numbers provided to use for these filings, which they indicated will be available starting on April 17th. As a result of the ability to now carry back losses incurred in 18, 19, and 20, a few other issues arose that might have caused taxpayers a problem. But the IRS issued RevProc 2020-24 to address and resolve these issues. So what are the issues and how did the RevProc resolve them? The first one is a result of the rule that requires NOLs to be carried back before they can be carried forward, unless an election to forego the carryback period is made. But that election must be made with the tax return that reflects the NOL. So for taxpayers that have NOLs in 18 and 19, if they filed their 19 tax return already, they would not have made that election on those tax returns because at the time they filed those returns, there was no ability to carry those losses back. So there would have been no need to make the election. As long as the taxpayer wants to carry the loss back, there's no issue because they never made the election to waive the carryback period and they're actually required to carry the loss back. But if they want to carry the loss forward, prior to the issuance of this RevProc, it was unclear how or if this election could be made. So the RevProc provides the ability to make this election on the tax return for the first taxable year ending after March 27th, 2020. So for calendar year taxpayers that have NOLs in either 2018 or 19 that don't want to carry the loss back, they can make this election to forego the carryback period for those NOLs on their 2020 tax return. There must be a separate election for each taxable year that there is a loss, and the election is irrevocable. Another issue that arises from this new ability to carry back the losses incurred in 18, 19, and 20 is when losses are carried back to a year in which the taxpayer had Section 965 income and incurred a toll tax that it elected to defer and pay over 8 installments. The reason this is an issue is because when there's an overpayment on a tax return where there are outstanding installment payments due to the toll tax, any overpayment first gets applied to those installment payments before the taxpayer can apply it towards their next year's income tax or get a refund. So in order to help taxpayers get more money in their pockets currently, rather than simply prepaying their deferred toll tax installments, the CARES Act provided taxpayers the ability to exclude any year in which there was 965 income from the carryback period. And RevProc 2020-24 provides that in order to do so, an election must be attached to either the tax return in which the NOL arises, a quick refund claim application, or the earliest taxable year in the carryback period that utilizes the NOL on an amended return. This election is also irrevocable. So if you only remember one thing that I spoke about today, I would say that it is to make sure that you fax your refund claims to the number that will be provided by the IRS in a couple of days so that your refund request is not sitting in a trailer collecting dust until the IRS reopens their offices, whenever that may be. And now, John Gens will discuss the effect of the CARES Act on tax provisions.
Thank you, Allison. That was lovely. Next slide. There we go. My name is John Gens. I'm a tax partner in the New York City office, and I'm going to cover the impact of ASC 740 and the income tax accounting of all these things we've been hearing about. So there's many items in the CARE Act that are going to have income tax implications. There's going to be changes to deferred taxes, which is going to include changes to the valuation allowances, balance sheet classification, potential impairments of assets and goodwill, and the potential inability to forecast due to these economic disruptions. The CARES Act impact is included in the period of enactment, and it was signed into law on March 27, 2020. So for everyone that had an extension to tax season, unfortunately, provision season for Q1 did not get extended. And a lot of these decisions have to be made currently. Excuse me, a lot of these decisions have to be made now in order to report these correctly in the first quarter provisions. Consideration, as Dave Seiden mentioned, should also be given to the state impact of these changes, and there's many items where additional work papers will need to be put together for the provisions in order to calculate the impact of the CARES Act. Net operating losses. So as Allison just went over, all the carryback opportunities, the removal of an 80% limitation, we need to look at how this is going to impact the accounting for income taxes. So federal and state NOL carrybacks, they may be one of the 4 sources of taxable income to support the realization of other deferred tax assets. And since the federal tax rate has changed from 35 to 21%, it also may require the federal net operating loss deferred tax assets to be remeasured, or part of them to be remeasured at the 35% or a higher rate that they can recover this in a back year. Valuation allowances may no longer be necessary against net operating loss deferred tax assets if this new carryback opportunity is available. These changes, since the law was enacted in Q1, need to be reflected discreetly in the period of enactment. And keep in mind, credits originally claimed on prior year returns, such as foreign tax credits and R&D credits, may now result in carry forwards after you carry losses back. And if you had valuation allowances against other tax attribute carry forwards like the NOLs, you may now need to have valuation allowances against some of these credits. So it's a lot of circular calculations in coming up with the proper reporting for Q1. And as Michael went over, the 163J interest expense limitation, the current year tax effects resulting from this increased ATI limitation, and the election to utilize 2019 ATI for the 2020 limitation should be reflected in the current year annualized effective tax rate. Additionally, the federal and state income tax effect of changes in the prior year ATI limitations should be accounted for discreetly in the interim period. That includes the date of enactment, including changes in any valuation allowances. Now, it is possible that the change in this interest expense limitation for 2019 may transition that year from a positive taxable income year to a net operating loss, resulting in a carryback. And again, that carryback may need to be revalued at a higher tax rate and create an additional benefit and some much needed cash for many of the companies. Companies should also consider the international tax impact of this increased ATI limitation, such as the impact on FDII, GILTI, and BEAT. Alternative minimum tax refunds. AMT credit carry forwards may be presented as either a current or non-current receivable or a deferred tax asset in a prior period balance sheet. Now, the presentation of these refundable AMT credits in the balance sheet should be updated to reflect the timing of when these credits are expected to be utilized from a non-current receivable or deferred tax asset now to a current receivable. Qualified improvement property, as Paul covered earlier. The impact of qualified improvement property technical correction on any position taken in a prior period should be recorded discreetly in the interim period that includes the date of enactment. Again, these potentially significant depreciation deductions could trigger a net operating loss in a back year that can be carried back. And companies may plan to file federal and state amended returns for prior periods to claim a benefit, which could result in a refund receivable and a change in the deferred taxes related to all your fixed assets. Companies should consider the potential rate impact of qualified improvement property technical correction if it creates an increased NOL to a back year. And the technical correction constitutes new information that may be allowed for recognition of uncertain tax positions and related interest and penalties. So if you took the position in a back year that this was qualified improvement property when it was not enacted into law, you may have had an uncertain tax position on your financial statements, which is now reversed as a result of this technical correction. The indefinite reinvestment assertion. So due to these economic disruptions, companies may need to evaluate their indefinite reinvestment assertion for both historic and current earnings. Are they going to be distributing cash from foreign subsidiaries back up to the US entities? So companies that do not assert indefinite reinvestment may be subject to other taxes on those earnings, such as withholding taxes. And the foreign currency translation adjustments related to foreign withholding tax liabilities from year to year are recorded through the income statement and rather than through equity. And companies that no longer assert indefinite reinvestment would also need to consider potential deferred taxes related to unrealized foreign currency gains or losses on previously taxed but unremitted foreign earnings included in the toll charge. State taxes and changes in law would also need to be considered when evaluating the indefinite reinvestment assertion. Next slide, please. Grants and employee retention credits. There currently is no US GAAP that specifically addresses the accounting for business entities for governmental assistance. Companies will need to analyze the nature of the assistance and look to available guidance or similar transactions to determine a proper accounting treatment. For instance, is there guidance in IFRS that may assist with how to record these items in the financial statements? For instance, the payroll protection program loans are classified as a loan until they're potentially or partially converted to a non-taxable grant. If all or part of the loan is converted to a non-taxable grant, this will be a permanent book-to-tax adjustment and a discrete item in the reporting period of conversion, also impacting the annualized effective tax rate. And of course, keep in mind any state and local tax impacts to these conversions as the states are trickling in information and whether or not those are going to be considered non-taxable grants for state purposes is yet to be seen. Next slide. I'd like to hand it off to my partner, Ron Hecht, who's going to cover the impact on the individual returns of the business tax provisions.
Thank you, John. I'm Ron Hecht. I'm a partner in the firm's White Plains office. And I have the distinct pleasure of taking the business changes that have been so eloquently explained by my colleagues and trying to tie them together with some key individual changes and raise some questions and some thoughts that we all will need to go through to determine which way we need to proceed with all these changes. This certainly brings to mind an observation that I have been making for decades in this practice, that preparing business returns in some ways are easier than preparing individual returns. And the reason I say that is, at least in business returns, we are presenting an income statement, meaning taxable income, the balance sheet, a reconciliation between book income and taxable income, and all those three schedules need to tie together nicely, and we have comfort that things are all accounted for and presented correctly. We don't have that benefit in preparing individual or trust returns. Having said that, the business changes that an owner-operated business or somebody with an interest in a flow-through business must account for are bonus depreciation changes, which were discussed already, the interest expense limitations that were discussed. The one thing I would point out in the interest expense limitation change area is Mike Klein mentioned that there is an election in 2020 for partners to be able to deduct 50% of the previously limited business interest. Keep in mind that that will normally be an individual's decision. The excess business loss suspension, which was not dealt with in detail today, was a provision of the TCJA that limited an individual's ability to deduct business losses to $250,000 per person per year, meaning on a married filing joint return, business losses in excess of $500,000 were not deductible. The CARES Act temporarily suspended those rules and will give an opportunity in years 2018, 2019 to be able to fully deduct losses that may have previously been suspended on returns that were filed. The net operating losses, which were discussed in detail, where we have gone from no carryback period to a 5-year carryback period, would have two potential impacts on individual returns. The obvious one is when entities amend their tax returns to take advantage of some newly created deductions. Amended K-1s may create net operating losses for individuals, but in addition, if an individual has business interests directly on their tax return because they are sole proprietors, these business tax law changes may directly impact an individual's income tax balance. The individual only changes quickly are if you have a COVID-19 based defined contribution plan distribution, meaning if you or a direct family member were impacted by COVID this year, or were impacted through a significant economic impact of the coronavirus pandemic, you have the ability to take a $100,000 distribution from your defined contribution plan without incurring any tax penalties. And these distributions would be taxed over a 3-year period of time. You do have the option, if you take those distributions, even though they will be taxed over a 3-year period of time, over a period that begins on the day you took the distribution, you have 3 years to repay those distributions to your plan and have the amount be non-taxable. Required minimum distributions, while on their face these changes are relatively simple, also require some thought that we will get to in a minute. But what the rule presents is that if an individual is required to take a minimum distribution from a defined contribution plan in 2020, they have the option to elect not to take the distribution. Similarly, charitable distribution rules have been changed and liberalized for both non-itemizers, allowing a $300 deduction, or for itemizers increasing the adjusted gross income limitation from 60% of adjusted gross income to 100%. Next slide, please. Taking all this and trying to put it together, the things we need to talk about, and Allison touched on some of them, is if you have a net operating loss at the individual level, first thing you need to take a look at is looking back over 5 years. What tax rate were you in those prior years? Were you subject to regular tax rate of 39.6% or the alternative minimum tax rate of 20%? That becomes a key determination in whether a net operating loss would be more beneficial with cash in your pocket now, or may be more valuable as we look to move forward with a top tax rate of 36%. Once you get past that first hurdle with net operating losses, we may see that if you carry back a net operating loss 5 years, if you've reduced your 5th year back taxable income to 0, if in that year there were credits that were used, such as foreign tax credits, those foreign tax credits are freed up, which can further result in additional carrybacks. Lastly, in the net operating loss or significantly reduced taxable income year, if you don't have a carryback or the carryback is not worth significant funds, maybe the issue would be to leave the net operating loss or reduced income in 2020 and consider, instead of waiving an RMD, a required minimum distribution, consider maybe taking a larger distribution in 2020 to take advantage of the lower tax rate that you would be in because of these amended returns. Trust issues are all almost identical to the issues that I discussed for 1040s, with the further complication that to the extent that a trust has a net operating loss, if the trust chooses to carry this net operating loss back, it may either result in a refund of trust taxes or require issuing amended trust K-1s to beneficiaries, which would then trigger the carryback issues or amendment issues that I described for the individual directly, trigger them again because of an individual's interest as the beneficiary in a trust. With that, next slide, I believe, is a polling question, and a very difficult polling question. Do you need CPE credit for this session, yes or no? Having given an appropriate amount of time to answer this most difficult question, I will turn the microphone back to Andy for some further discussions.
Thanks, Ron. Good afternoon again. As businesses try to survive the COVID-19 pandemic and restart in its aftermath, cancellations and modifications to existing debt agreements are all but certain, and in some cases may even result in bankruptcy. Understanding available tax planning opportunities can help mitigate risk and preserve company value during this crisis. In this segment, we are going to discuss the types of transactions that can result in cancellation of debt income, when that cancellation results in taxable income, if this income can be excluded, and at what cost. So let's take a look at some basic concepts. When a business borrows money from a bank, it is obligated to repay those funds. So the cash received from the loan does not represent taxable income. However, if the debt is canceled in whole or part, the difference in the amount borrowed and the amount repaid can result in cancellation of debt income, subject to tax, unless an exclusion applies. So what are some of the transactions that can result in cancellation of debt income? Well, the obvious one, cancellation of debt by the lender. Substantial modifications of debt. Let's say you have a 5-year note with 10% interest and you modify the note to be paid over a 10-year period with 5% interest. If this modification turns out to be a significant modification, the modification might result in taxable income. Debt for debt exchanges oftentimes are similar to debt modifications. Debt for equity exchanges. Let's say you exchange debt with a face amount of $10,000 for a partnership interest, sometimes referred to as a contribution to capital or recapitalization. This exchange can sometimes result in cancellation of debt if the equity interest has a value less than the face amount of the debt. There are some other considerations, including excuse me, acquisition of debt from the lender by a related party at a discount. Exceptions to COD income. Like so many other areas of tax law, there are always exceptions. Let's take a look at some of the key exceptions. Loss deduction. To the extent an item is forgiven when paid would result in a tax deduction. Cancellation of debt would not result in taxable income. Purchase price modifications provides an exception if the debt issued by a purchaser of property to the seller is reduced. Bankruptcy. Debt forgiven as a result of bankruptcy proceeding is excluded from taxable income. Excuse me. The insolvency exception is by far the most widely used exception. Cancellation of debt income is excluded to the extent the borrower is insolvent. This requires a solvency calculation, which we'll take a look at in a moment. Then we have real property business debt and qualified farm debt, all that can be exceptions. Insolvency exception. Cancellation of that income is excluded to the extent that that discharge occurs when the taxpayer is insolvent. Income excluded shall not exceed the amount of insolvency. Insolvency is computed immediately before the discharge. So for C corporations and S corporations, solvency is computed at the entity level. For partnerships, solvency is computed at the partner level. Insolvency is defined as the excess of taxpayers' liabilities over fair market value of its assets. Goodwill and going concern value must be considered in this analysis. Contingent liabilities should only be included if they are expected to be paid. Taxpayers have the burden of proof that they are insolvent. So you should obtain a qualified appraisal effective as of the date of discharge and prior to the filing of your tax return that includes the debt forgiveness. Local tax assessments like real estate bills are not going to be accepted. Next slide, please. Attribute reduction is the cost of utilizing the cancellation debt income exceptions. Tax attributes must be reduced to the extent of the excluded COD income on the first day of the following tax year in the following order: net operating losses and related carryovers, credits, capital losses, tax basis reductions of depreciable assets, passive activity losses and credit carryovers, foreign tax credit carryovers. And this attribute reduction is required even if in bankruptcy or insolvency exceptions apply. You should note that there's an election available to reduce the tax basis and depreciable assets first before reducing NOLs, which may help to preserve NOL carryovers. There are some special rules for pass-through entities. For S corporations, the test for insolvency takes place at the corporate level. Attribute reduction also takes place at the corporate level. Suspended losses at the shareholder level are reduced to the extent there is an exclusion of COD income at the corporate level. So although S corporations don't have an NOL like C corporations, to the extent shareholders have suspended losses from S corporations, this individual attribute becomes an attribute of the S corporation that is reduced. Any taxable cancellation of that income increases shareholders' basis. Any COD income excluded as a result of this exception does not pass through to the shareholder and does not increase shareholder basis. And for partnerships, the rules are different. Cancellation of that income passes through to the partners always. Partners' basis in the partnership interest is increased by the partner's share of that COD income. Ability of any exclusion of COD income is determined at the partner level. The test for insolvency takes place at the partner level. A partnership may be insolvent, but some or all of its partners may be solvent. In such an instance, the insolvency of the partnership is not a relative factor in determining whether or not you have an exclusion. So cancellation of debt income may be excluded only by those partners who are themselves bankrupt or insolvent. At this point, I'd like to turn the presentation over to my partner, Nicole.
Thank you, Andy, and good afternoon, everyone. The CARES Act provides for deferral of the deposit and payment of the employer's portion of Social Security taxes that would otherwise be required to be made during the payroll tax deferral period. This deferral period begins on March 27th and ends December 31st, 2020. There is an exception which says that this payroll tax deferral does not apply to any taxpayer if the taxpayer has had a loan forgiven under Section 1106 of the Act with respect to the Small Business Act, otherwise known as a PPP loan. In order to have the PPP loan forgiven, an employer must maintain a certain number of full-time equivalent employees over an 8-week period. What this means is that employers may not know for several months whether they have met the qualifications to have their PPP loans forgiven, and if so, whether the lender has made a decision to forgive the loan. The question that we've been asking was, what happens in the interim? Can the employers take advantage of this deferral of payroll tax up until the point when the loan is forgiven, or would doing so expose them to potential penalties? The IRS just published FAQs which specifically allow for all employers to defer the deposit and payment of the employer's share of Social Security tax. Employers who have received a PPP loan, but whose loan has not yet been forgiven, may defer deposit and payment of the employer's share of Social Security tax beginning on March 27th, 2020, through the date the lender issues a decision to forgive the loan in accordance with the CARES Act without incurring penalties. The deferred deposits and payments of the employer's share of these payroll taxes must then be paid on the applicable dates of December 31st, 2021, 50% of the deferred amount, and December 31st, 2022, the remaining amount, in order to avoid failure to deposit or failure to pay penalties. Form 941, the employer's quarterly payroll tax return, will be revised for the second quarter of 2020, and the FAQs mention that information will soon be provided instructing employers how to reflect the deferred deposits and payments otherwise due on or after March 27th for the first quarter of 2020. This ability to defer deposits of the employer's share of Social Security is in addition to the relief provided in Notice 2020-22 for deposit of employment taxes in anticipation of the Families First Coronavirus Relief Act paid leave credits and the CARES Act employee retention credit. This means that an employer may defer deposit and payment of the employer's share of Social Security tax prior to determining whether they are entitled to the paid leave credit or the employee retention credits. As a reminder, self-employed individuals are also eligible to defer payment of 50% of the 12.4% tax on net earnings from self-employment income during the period beginning March 27th and ending December 31st, 2020. Thank you. I will now turn the mic over to my partner, Will Fernandez.
Thank you, Nicole. We're heading towards the home stretch of the program, and I'm going to speak to you about the Main Street New Loan Facility. Effective April 9th, the U.S. Federal Reserve introduced the Main Street New Loan Facility program. It's eligible for borrowers with businesses with up to 10,000 employees or up to $2.5 billion in 2019 revenue that have been created and organized in the U.S. with significant operations in and a majority of employees based in the U.S. The companies can also participate in the PPP programs and also the Economic Injury Disaster Loan programs. However, they may be restricted from participating in any other U.S. Federal Reserve program, so you need to check if you're participating in one of those programs before you apply for this loan. The loan features are as follows. It's a 4-year maturity, it's unsecured, deferral of amortization of principal and interest for 1 year, adjustable rate based on secured overnight financing rates, which is almost essentially zero, plus 250 basis points to 400 basis points. The minimum amount of the loan is $1 million. The maximum loan is the lesser of $25 million, or an amount when added to existing outstanding debt and committed but undrawn debt does not exceed 4 times 2019 EBITDA. So if you thought the tax law was kind of complicated, this loan is also kind of complicated. But essentially, it's basically driving companies that are having difficulty obtaining traditional financing, but reflect sufficient cash flow to service the additional debt if they receive it. There's no prepayment penalty, cannot refinance or prepay existing debt, cannot cancel or reduce existing lines of credit, must have been impacted by the COVID-19 pandemic. And finally, the companies must make a reasonable effort to maintain its payroll and retain employees during the term of the loan. I'm now going to pass it on to my partner, Mitzi Hollenbeck.
Thanks, Will. I appreciate it. And certainly, we don't actually have a slide related to the PPP program and the EIDL program because the majority of this webinar is focused on the tax provisions in the CARES Act. But we wanted to give you an update. We certainly have done other external webinars related to the PPP program and the EIDL program, and we'll continue to keep you informed and updated. You can always check our COVID-19 response website so that you can get up-to-date information related to the latest releases related to these programs. So just by way of a quick introduction as to what has changed in the past 24 hours for the most part, because every day seems to be a new acknowledgement of something happening or interpretation related to these particular loan programs. just yesterday, what happened was we had another release of a new interim final rule, which kind of clarified a little bit of the information that existed out there with regard to sole proprietors and partners in partnerships related to their eligibility and the calculation of total maximum allowable payroll for purposes of the calculation of the PPP grant. So yesterday, within that guidance, specifically, it allowed for partnerships with general active partners are able to have up to $100,000 of their self-employment income included in the partnership loan application. The interim final rule also clarifies how to calculate the payroll amount required or allowed for a Schedule C or sole proprietor in those particular, I won't say they're frequently asked questions, it's just another an interim final rule. Some of the other major changes that have happened in the past week related to the EIDL program, there actually was a letter that was issued on April 10th, 2020, really it was from the U.S. Chamber of Commerce to Congress, really asking and trying to clarify some of the information with regard to the SBA guidance on the EIDL program, which previously allowed loans up to $2 million. We haven't seen this necessarily published in authoritative guidance yet to really show that the EIDL program has kind of come to a little bit of a halt right now. We're not sure when the applications that have already been submitted to the SBA may be impacted by this guidance, but it appears as though the SBA is somewhat rationing the maximum amount of these loans. We also know that what happened in the past week is that the EIDL advance grant, which is provided for in the CARES Act, which used to be a $10,000 grant, which was forgivable if you applied for the EIDL, you were denied the EIDL, or you applied for the PPP and the EIDL advance grant, you could use it as part of the offset to the PPP loan forgiveness. Well, that was clarified and changed to be a maximum of $1,000 per employee within your operations. So for this advance grant, but if you only have 3 employees within your organization, the maximum advance grant you can receive now is $3,000. Certainly, we're seeing a lot of banks that are coming up with different, they're almost on different time frames with regard to funding some of these loans. Some of the applications and the requirements with the banks are certainly different. And we are awaiting additional guidance related to the calculation. It's so really, what we're just cautioning everybody on, and we will provide further guidance on the forgiveness calculations related to the PPP loans. These are loans of your business, and just be prepared with regard to your cash flow needs and your cash flow projections that this may be something that you may end up having a piece that is not forgiven. I do see one question that I can just answer on the air right now. It is related to a PPP loan question. It says if your payroll is paid twice a month and the period for measuring expenses for forgiveness is only 8 weeks, what happens in that case due to your payroll dates? We hope that they'll clarify whether or not this will be cash basis or accrual basis on the payroll. We are not aware of what that guidance might look like, but certainly stay tuned. That being said, I'm going to turn this over to Jamie, who's going to explain some of the state and local tax issues that you should be considering.
Thanks, Mitzi. My name is Jamie Reichart. I'm a director for state and local tax in the Philadelphia office. And I'm just going to quickly run through some unique and interesting opportunities that are coming to a head in the state and local world. As I'm sure many of you seen, there's a lot of moving targets and deadlines with a lot of tax returns, income tax returns, sales tax returns, as well as programs for deferral of those payments. What I'm going to talk about very briefly now is just some different financing and incentive programs that states are offering. And the key point that I'll drive home before I touch upon just a sample of some of these programs is we're doing our best to monitor them and keep up with all the updates and get those out. And just the key thing is a lot of the time they require swift action because a lot of the programs are closing up very quickly. So as a couple of examples of some of the programs that we're seeing across the different states where we have offices, for instance, in California, San Francisco has a zero interest loan program for up to $50,000. Los Angeles has a small business emergency microloan program. Interest rates can vary from 0 to 5% with loans from $5,000 to $20,000. California statewide has a disaster relief loan guarantee program Loan guarantees can be up to $1 million for loans of up to 20 million. Guarantees can be up to 80 to 95%. So it's pretty significant. And moving away from California, some interesting examples of states that are taking the approach of incentivizing certain activities in light of the current COVID-19 crisis would include Connecticut and Maryland, who are specifically providing incentives for manufacturers that produce critical medical equipment and supplies needed for the emergency, or those that pivot their manufacturing operations to do so. So Connecticut is providing grants of up to $75,000, but requiring a one-to-one match from the business, whereas Maryland is providing grants of up to $100,000 for manufacturers providing, and producing these goods. So those are two programs that are unique, that are providing different benefits for those manufacturers. New Jersey, another example of a state that has provided different loan guarantee programs. There's an entrepreneur support program for those that have invested in emerging innovation technology businesses. It's a $5 million loan guarantee program. There's also the Small Business Emergency Assistance Guarantee Program, which provides loan guarantees of 50% up to 100K, and those are through EDA and its premier lenders. And finally, Rhode Island has a host of programs in particular areas, specifically to the East Providence area, for different job retention loan programs as well as grants. And so, again, the key takeaway here is just running through those programs is to monitor what's happening and act quickly when we get that out, because these programs, have a lot of demand. And additionally, we expect to see some new legislation coming down the pike when legislatures get back into session this summer, where we expect to see additional rounds of some of these grant programs and loan guarantees that have been closed, as well as potentially new different tax credit programs. By way of an example, David Seiden had mentioned New Jersey's tax deadline, but some other bills that the legislature has been, considering and actually voted on are bills that would provide for a state tax credit to mirror the federal CARES payroll credit to give 20% of that amount, as well as different programs to allow businesses to apply for deferral of all business taxes. So again, another takeaway is we're going to be monitoring that legislation, but we expect to see increased activity for financial resources to businesses, as well as, as the economy opens up in the coming weeks and months ahead. We expect that states and localities are going to have to come up with new programs to incentivize companies to undertake projects. So we think that there's going to be additional opportunities to pay attention to as well.
All right, so that concludes our webinar today. Thanks to everyone for listening in. Thanks to all the speakers. Great job. And I wish everyone out there to stay safe and carry on. Thanks.